Good evening. This is Rodney with the Triton Wave Market Outlook for Monday, November 11th, 2013. And this is brought to you by Triton Wave Consulting, which is the home of the Triton Waves. The Triton Waves are early warning market timing indicators used in all time frames in all markets worldwide. Okay, I'm back after about a 5-week break. The last video I did was September 30th. After putting up 115 videos, I decided to take a little break and do an assessment, do some back testing, see if I can improve the waves a little bit, the timing, and I came up with a few things that I'll share with you. First, I want to look at the, I believe that you can see this on the chart. This is from a place called tradingview.com, and it's free to use. You don't even have to sign up to use it. But this top, let me see if I can get my drawing tool here. Okay, this top way, hang on, let me change the color. That's not good. Colors. Cyan, magenta, let's try this one. Okay, that'll work. Alright, so basically I've set up 4 streams of information here. The top one is the E-mini futures, the ES, otherwise known as the ES. The second one is the Aussie Yen cross. This is the Aussie Yen cross. The third one is spot gold. And the fourth one is the dollar index. And I wanted to go back and show you during a crisis what happens. Now this is July through October of 2008. And we noticed that the E-mini, that we'll just call it the S&Ps. The S&Ps went down in concert with the Aussie against the yen, which means that this was risk all the way down here. It means it's risk off. When the Aussie yen is going up with the market, it's risk on. Of course, sideways is sideways. When it goes down, it's risk off. Okay. Also in concert with that, because the market usually goes up, it's one of the inflationary hedges that we've been using as investors for the last 50, 60 years. And the gold tends to go up with it, even not in the same pace, but at its own pace. And it doesn't look like it's going down here much, but it actually, when from this point to this point in the S&Ps and the market, which was about a 6-month period, gold actually went down from 1,000 to like 650. So that's, it's a 30% drop. All right. Now, in contrast to all that, the dollar is the safe haven for all this. So you can see as these are moving up here gradually, and everybody's making some nice money, the dollar is tapering off. But in a crisis, when all these things are moving down, and you would expect gold to move up when there is a crisis, but in actuality, all asset values get sold, except for the dollar. And you see this dollar spike the whole time the market was going down. So I just wanted you to note that. Okay, now that we have history out of the way, let's go back and see what it looks like right now. It's kind of like, let me see if I can fast. Okay. So now we're in the present. Let me expand this just a little bit here. These are all daily charts, so you get a big picture look of what's going on. Okay, let's get my magenta arrow out here, and we see that the market is moving. The ES is moving up, and the Aussie dollar from this point on, let's just do this line of demarcation back to October of 2012. And the Aussie dollar risk on up until about May. And then even though the S&P kept moving up like this, the Aussie dollar had a risk off sign, and then it went side, and then it went up and down. It went up and down with the S&P going up and down, and this kind of moved up and down. But it really never took out this peak here that the S&P did. That is a monumental red flag. All right, gold. From this point on, gold has been going down. It has not followed the inflationary track of the S&P or even partially the risk on of the Aussie dollar. This is a major, major red flag. Okay, the dollar has been going down and either up a little bit, sideways, down. It's really kind of been a non sequitur. But it's starting to move up again, and it's breaking this 5-month downward trend, and it came, it's hard to see here, let me open it up a little bit. Let me redraw this so you can see it. And this was a downward trend going on since last July, that it broke to the upside, and this is portending a continued move to the upside, which means that gold is going to continue moving down, and it means that the Aussie dollar is going to keep moving down, because look at this, it never from here to here, I don't even think that's a 50% retracement of this. Whoops. Let me try that again. I don't even think that's a 50% retracement there. It might be like a 38. Maybe it's 50, but that would be perfect if it was 50. And this continues unabated. It means money's just chasing money is chasing money, and somebody's going to get burned, because, you know, in musical chairs, the last guy who loses out ends up on the floor, and it's painful. And all right, that's the way I'm looking at the overall picture right now. Let's break it down and look and see what's going on with the S&Ps by themselves. Okay, so let's look at the S&Ps, and let's look at what I was talking about 5 weeks ago, when if we close this up a little bit, we can see that let me hang on a second, I'm just changing the color here to yellow. Okay, so we're looking at as the S&P moves higher and higher and higher, and this is where we were September 30th, the last video. I was making a note that the waves were in succession moving lower and lower and lower, and that the shorter wave on T2 was still below zero. Okay, so what happened? It went below, and I actually thought that was going to be like the beginning of a mini, like a 600 to 800 point move in the Dow. What happened was that it hit this major trend line here, and I'll show you on another graph how actually very distinct it is on a short-term graph. And this came back above zero. So at least temporarily, it negated the sell. So when T1 went above zero, that also negated it. So so for at least a temporary while, this move in the past 3 weeks has negated this sell signal. But if we look at what's going on here, it actually, let's see here, let's make this, now T5 still looks very good, but T5 is going to look good even if the market goes down 1,000 points. Then you're not going to make money trading just on the larger waves. You have to pay attention to the smaller waves, T1, T2, and smaller time frames, which we'll get into in a minute. But even now, T2 is still below zero, even with this massive move up. And this move went from 1640 all the way up to 1773. So it's the 130 point move, which is definitely substantial. It didn't move a lot of stocks, but it moved the big stocks. And if you were in the small ones, then you may have made another 1 or 2%. But the fact remains that T2 right in here is on the shorter wave is still below zero. And if you look at the really big picture, the longer term picture, if you notice that these are still descending waves right here and right here. Whoops, they're actually smaller. And even though this has been going higher and higher and higher, I still do not like this to the upside. Uh, what what you may want to make a note is that just in terms of cycles, like time cycles from here to here, from here to here, from here to here, from here to here, we're due for even a minor pullback, because this went up, this came down, and it's zigzagging. It's moving, zigzagging up, but with up and down cycles each time. So we're kind of at the apex of this. If it comes down to here and even comes down to this trend line here, that trend line is 1670, which is a good. What do we know? We're 1765, so it's 95 points away. It's 900 points in the Dow, which would actually bring this wave back below zero, T1 below zero, and it would continue T2 below zero. So it may, in a panic, which I think we could be because of the confidence or lack of confidence in the Fed, we could actually come down below 1670 and come right down to this line that I'm going to call wave A. And if I cinch this up a little bit, these are moving averages that I've been playing around with. We're gonna call the dark purple one A and the light purple one B. So this is A and B. The A is obviously closer in, and you can see from past history going back all the way to a couple years that, in fact, when the market did take a breather, it came right down to A back in December of 2011, came back to A again back in May of 2012, and then November 2012, and if it comes back down to there, we're talking about 1545. And it can still be in an uptrend, but knock 220 points off the S&P. So don't get caught being greedy with all these high-flying stocks. That's all I'm saying. Okay, on a shorter-term picture, this is the 144. This is the 144 cash price on the ES, and you can see that the wave A held here, it held here, and these are all. Let me see, 976. These are all back to October of last year. When it came back here, spiked off of it. That was June, and it came back again in September. And these are just normal up and down cycles as it moves up. If indeed it's still moving up, you still have to pay attention to the normal cycle. That brings us down to 1668 right here, and we're currently at 1765. That's 100 points, and that's that would be a minor move. That's beside the major move that I'm already talking about on the daily chart. And if we move even closer on this, if we change this 144 to a 24-hour chart, let's see if we can see anything more here. Okay, so this is with the S&P right now. Open on Sunday. It is 6:30 Central Time, and you can. These are pretty good markers here. This is equivalent to a 21 period cash price during the day, or actually a 34. But you can see how if we just follow. Let's try the B wave. I mean T2. When it crosses here, I'm just making the cross marks, and we'll look up and see where it's affected. So that went down here. You took a tiny bit of heat for like 5 or 6 points, and then boom, you got that. Up on the upside, you captured that. Up on the downside, that, and so on and so forth. And now it's crossing back over on, and you're taking a little bit of heat up here, and it looks like it's moving down. And if it progresses to move down, it shouldn't have any problem moving back down to this area past wave A and down to about 1670, which is what I said in the other graph. So that's the big picture that I'm looking at. Let me see if I see anything on the weekly. The only thing I see on the weekly is, let me see if we can get something here. The weekly is not quite to the 1272 extension. So the possibility is, I mean, it's always possible that it'll move up. It just doesn't look like it to me. But it is possible that if it does move up, that 1836 would be a target. It just looks like it's tired to me. So if we do move up, we're going to grind and grind and grind very slowly, and you'll wake up one day and it's going to wipe out. Just like, well, let me go back to the daily, and I'll show you the wipeout that happened. Okay, this wipeout that happened on, this is Thursday, this is Friday. So the wipeout that happened on Thursday took out 10 days of trading. Now granted, on Friday, it gave you back 9 days of those trading. But if you look at it, if you look at the candles, the wick on the candle was lower than the day before and shorter than and the high side was shorter than the day before. So it was all contained within, it didn't move higher, but it did move lower. So that's another part of my reticence in thinking that this is going to move higher, because this is the wick right now today, and this could just come down Monday, Tuesday and hit this. That's actually what I'm looking for to happen. It may not happen by that way, but that's what I'm looking for. All right, let's look at a key stock, because this is already running almost 20 minutes. Let's look at a key stock. Let's look at Apple, everybody's favorite. And it looks like T1, T1, 2, and 3. 3 went above 0 about 8 days ago, but since it's been above 0, it's been going flat to down. Long-term chart on Apple, down and down on T 4 and 5. So let's look at the 144 on this. Oops. Get rid of that. Get rid of that. Let's change the time back to day only. And now these, you have to understand that the Triton waves are early warning systems. So they're not going to happen right, unless you're looking at a tick chart, like a 144 tick chart, and you've got about 25 seconds to get in. These are nice, long, take your time waves. So you don't have to get in as soon as it crosses. You can wait, like a couple hours a day, and you'll have plenty of time to get in. Okay, so for instance, back in July of this year, right about at this, whoops, right about at this crossover price, when Apple was selling for about 430, and this crossed right here, and you had 2 or 3 days to get in. It went up a little bit, came down a little bit, but gradually the trend was up, and it crossed the. Okay, what I started to tell you before, this is the EMA A wave that I'm calling, and this is an EMA B wave. So when they start crossing, um, when the stock is riding a trend above both the A and the B wave here, then it's okay. When it starts crossing down over there, I'm calling this area in between the neutral area, and it seems from doing a lot of 5 weeks of historical testing on this, they seem to bounce between the waves here. It may take time to do it, but they bounce, and it doesn't matter what time a frame is on. Now, if it bounces above this, then it might bounce up to here and come back down again. But you can basically count on a stock moving up if it's above both this A wave and B wave. EMA, these are EMA waves, not any reference to ABC waves that I've written in the past. So these are EMA waves that I'm calling A and B. I may rename them just to not to be so confusing. But so this is kind of neutral territory. Even though it went down, it came down below it, came back up, kissed it goodbye, and came down. This is not looking at any of these right now. This is just looking at these moving averages. Came back, kissed off, went down. Now, if you can coordinate these moves off of these wave patterns with the waves that are going on with T1 through T5, that's really extraordinary. So this peaked out here, this came down, came back up here, kissed off of it, and went down again. Came back up, kissed off of it, and went back down again. So it's really, I've been finding some really neat patterns using this stuff. Right now, what I'm looking at is, now that we're on the 144 cash price on Apple, it is above both of these lines, so it looks pretty good. And even though the long-term daily is down below zero on T4 and T5, the short terms are up. Well, 144 is like only 3 hash marks a day, so it's kind of like a mini daily. But it is time. You know, these all happen in nice even cycles, bing bing, bing bing, and it's time for a new one right about here. So I do expect Apple to come down to 482 before it resumes its up move. And we can take a look at something a little bit closer, like a 21 move. Well, aside from the obvious moves that you can see from the crossovers of T1, T2, and then confirm T3, and then eventually T4 moving up like this. What I like from this new pattern is that I'm looking at, once this moves above here, once this moves above this wave configuration. See, like right here, it's all contained in this narrow, not only is it narrow, but it's in between A and B. And once it breaks out, it really does a nice breakout. It really does a nice breakout job right here. So even with the breakout, if it's still above and you're a long-term holder, then you can basically ignore A, B, and C, T1, T2, and T3 here, here, and here, and just pay attention to the very long ones, like these right here. This is T5, and this is not going below zero until way up here. So This is a nice pattern. As long as it keeps staying up, it'll step up, it'll keep stepping up, it'll keep stepping up. It bounced off here, bounced off here. When it breaks through, now it's in neutral territory. If it comes through, you can absolutely expect it to go down to the B EMA wave that I'm calling B. And if we come back out here, it comes back up again. It comes back up. The T1 is telling you that it doesn't want to stay down, and it actually goes into neutral territory. Right, goes up to the upside of the underbelly of A, comes back down with a 50% retracement, and then takes off again, and then hovers along this line, but it's above this, and it stays right in sync there. And since T4 is above 0, you can just ride this. You don't even have to pay attention to it. Just ride it all the way up. And if we get into the present right now, this is now bouncing off of 514, 513. And it's bouncing a little bit, but what you have to notice is that there's a balance between the riding up. Sometimes it's a precursor when you start noticing the waves moving below 0, like T4 and T5 here moving below 0, so that's a precursor to what is actually going to happen. Sometimes you can predict that this is actually not going to hold and fall down. If this falls down below 518 right here, then it's going to 488, and that could happen very quickly. So that's where I think this is going based on the 21. All right, that's all I have for this evening. Glad to be back. I'll try to get this out every week. In the meantime, have yourself a great evening and enjoy the rest of the weekend. Okay, again, my name is Rodney Julian, and if you would like to get in touch with me for your consulting needs, you can get in touch with me at Triton Wave Guy down here at gmail.com. Have a great evening.